0.25%, so a quarter of a percentage point. Interest rates have just been increased by that much. They are now up to 1.25%. That is the highest that they have been since 2009, and it's also the fifth successive meeting at which the MPC, the Monetary Policy Committee here at the Bank of England, has decided to raise interest rates. So put all of that together, and there's clearly one direction. It's worth saying, though, I'm just kind of scanning as the news comes through, because we'll also get the minutes on precisely which members have voted for what. It's worth saying, a lot of people thought there was a good chance that the bank might go even faster than that, raising rates by a full half a percentage point. Remember, last night, the Federal Reserve, that's America's central bank, they raised their interest rate, their main interest rate, by 0.75%. So the Bank of England doing this, some people will look at them and ask the question, are they moving a little bit too slowly given what we're seeing in the United States? They will argue that this is a kind of sense check, that there are lots of risks for the economy at the moment, that when you look at the state of the UK, yes, there is inflation incredibly high at the moment, but there is also the risk that we're facing a big energy price shock. That's pushing down on demand, and that means that people have their own issues to deal with at the moment. It's worth saying that just looking through some of the details that we're seeing in the minutes, they have also said that they are going to be expecting inflation, or at the moment their existing forecast says inflation's going up above 10%. They're now saying they expect it to go up towards 11%, so even higher than they previously thought, and that also that GDP in this quarter that we're in at the moment is going to fall. I would say that's kind of slightly more of a statistical, one of those statistical aberrations, because we have an extra bank holiday in this quarter and there's a lot of other things going on. But it does underline the fact the economy right now is not doing tremendously well. We are, if not stagnating, then potentially kind of having very weak growth right now. And that is part of the explanation for why the bank, although they are facing inflation so high at the moment, 9%, going up, they say now, to 11%, why they've only raised interest rates by 0.25%. But as I say, a lot of people will look at them and say, perhaps you could have gone even faster, even further, even though there are many people across the country who will feel the impact of this, of course, on your mortgages. It will, of course, increase savings rates as well, but a lot of people in high levels of debt at the moment, so this will affect them. So that's the decision that we've just had from the Bank of England. Interest rates up by 0.25% to 1.25%, a 6-3 vote, so there are three members of the Monetary Policy Committee who are pushing for slightly higher interest rates, but nonetheless, there's 9 members on there. It's a majority decision. It was 6-3 in favour of 0.25% increase in interest rates.
And Ed, I was talking to one of our guests about the historical perspective on this. It will seem high to those who've got mortgages since 2009, because their mortgages will be on a lower rate, for example. But if we look back to the 80s and 90s, rates were far, far higher, weren't they?
It's nowhere near what it used to be in the past. I mean, think back to before the financial crisis. I mean, it's now quite a long time ago, 2008, 2009. But at that point, what people described as the kind of neutral level for interest rates, so the kind of normal level, was about 5%, a little bit over 5%. We are now down at 1.25%. It is still, up until that crisis, we hadn't seen interest rates below 2% in the history of this place since 1694. So you have to go back a long way to find, well, there is nothing similar in terms of our kind of interest rates at the moment. But it is worth also saying, although that headline level of interest rates is at 1.25%, that's very low. Also remember that across the country, levels of debt are significantly higher than they were, a few decades ago. So the impact that people face as a result of that is more significant. Of course, also house prices are a lot higher, and a lot of other things have changed too. But yeah, in historical comparison, this is still a very low level of interest rates. But by the same token, look at inflation, up at 9%. That's the highest it's been since the early 1980s, expected to go comfortably into double digits. That's the Bank of England's new forecast. And that is why a lot of people worry that we might be facing a repeat of the 1970s. And what happened in the 1970s? You had inflation very high. You had the Bank of England, and indeed, remember, this is now an independent central bank, so they have their committee to decide interest rates. In the past, it used to be a kind of political decision, but you had interest rates trying to chase inflation and not getting it down for a long time. And as a result, you had a period of stagflation, as people call it, so high inflation, low growth. The worry and the people will look at the bank and say, are you aware of this worry? The worry is there is a chance that the UK could well repeat that, and indeed other countries around the world, because we're not the only country with high inflation. But worth just saying, Jane, inflation here higher than any other country in the G7, so higher than any other major country right now. And if it's heading up to 11%, it could well be the highest of all. So the fact that the Bank of England is raising rates more slowly than many other central banks, including the Federal Reserve, there will be some eyebrows raised about this.